All right, guys, welcome back to the channel. My name is Jose, and this is the IPO Nerd. It's always been the best place to learn about new companies going public. However, as you can probably tell by now, not a lot of companies want to go public in this type of market. I can't say I blame them. You know, even the IPOs that went out on public on the 2020 and 2021 are doing terrible today. So I'm going to share with you guys a couple of articles over here. The first one is for CNBC that talks about the Fed will raise interest rates in the near future. And what can you do to protect yourself? And I'm going to share with you guys what I did myself to protect myself from future upcoming rate hikes. We're also going to look at a Motley Fool article that talks about the stock market is not your emergency fund and the importance of having cash in hand. I'm also going to give you my opinion of the upcoming earnings that is going to happen next week and how they can affect the stock market. So we do have a lot to talk about today in this episode, guys. So make sure you drop a like and let's get right into it. Now, CNBC is reporting that the Fed will raise interest rates again. Make these money moves right now to protect yourself, right? So I'm gonna share with you guys right now what I did. I got out of any variable rate debt that I was holding, guys. This included M1 Borrow, okay? This included a credit card. This included a few other things. But if you have any variable rate debt that you are holding on to, you might want to go ahead and get rid of it at this time before it gets more expensive to borrow money, right? Which it will, guys. So far, they've done a couple of rate hikes. I think the first one was 25 points, and they did another for 50 points. And we are expecting another 2 or 3 50-point raises this year at least. The Federal Reserve on Wednesday released the minutes from its latest meeting showing that the central bank plans to deliver more 50 basis points rate hikes this year, likely at each remaining meeting on the calendar. So how many more meetings did the Fed have this year? 2 or 3, right? So you can expect a few more this year, guys. This is all done in an effort to tamp down inflation. Okay, that's understandable. The Fed may also raise interest rates more than the market currently anticipates. So they are saying that they're definitely going to do a couple more 50-point basis rate hikes, but it could also, you know, it's up to them to assess the situation, and they might go down to 25 basis points. They might even go up to 75 or even 1 basis point. So they're trying to get inflation under control because that is their main purpose. The Fed could care less about your investments and the stock market, right? Financial experts are saying that you should be paying down debt and shoring up personal budgets to be able to withstand any sudden shocks to the economy. Like I mentioned before, I did do that. I got rid of all the leverage that I had on my portfolio. Zero debt. That's the way to go whenever debt gets expensive to borrow. Right now, the average interest rate on a credit card is nearly 20% according to LendingTree. Guys, that is mind-boggling. I cannot believe that is the median, 20%. I can see how, because all these retail companies like Sam's and Lowe's and Home Depot and all that, they do have their own credit card that they offer you. But normally their interest rate is around 24%, 20 to 24%. And that is insane, guys. So you should be writing down your debt. You should be tackling the one that has the highest interest rate as soon as possible. Financial experts recommend taking time now to review your spending and saving to strike a solid balance. Now is not the time to be going out there, guys, and spending your money around and things that you do not need. We don't know what's going to happen with the future in the market. We don't know how long this war in Iraq, Jesus, not Iraq. We don't know how long this war in Ukraine is going to last. So you need to be building up your savings, building up your cash positions, which is what the next article from Motley Fool that we're going to look at talks about. As people plan future spending, such as an upcoming vacation, they may also want to budget more than they usually would. We've already seen the increase in gas prices. We've already seen the increase on groceries, guys. It's a great time to invest if you have the appetite for it. Literally just a few dollars a day, and the volatility that we're seeing can pick up a lot of value if you stay in the market long term. This is something that I do agree with. It's very true. Right now, the prices of stocks are very, very, very low. Some of them are down 50, 40, 60% from their all-time highs. So now it might be a good time to pick up those positions, build those positions, DCA, dollar cost average down on those positions, gather more numbers of shares. So that way, when the prices go back up, you can collect all those dividends and capital gains. Let's move on to the Motley Fool, to the article that says the stock market is not your emergency fund. I know a lot of you do that out there. I'm guilty of it as well. I do not like keeping any cash on my bank account whatsoever, but it is true nowadays. You have to do it, guys. So make sure you maintain a cash reserve. it's a sign of wisdom, it says right here, right? I know there's a lot of liquidity when it comes to stocks and all that, but there's also penalties when you file for taxes. There's also, the risk that those assets will depreciate. So make sure that you're always keeping cash in hand. The S&P 500 has fallen 17%, while some of the big tech names are down almost as much as 90%. All the pandemic stocks like Peloton and Zoom and all those are taking a big beating. Shopify, all these companies are down big time on the NASDAQ. An emergency fund can provide psychological comfort and practical insurance in the event that we enter a bear market and stay there for an extended period of time. We don't know how long the market will continue to fall. So you need to be prepared mentally, physically, emotionally. We already know that not a lot of people will be able to handle seeing their investments go down 40, 50, 60%. But that is a possibility. First, cash will provide security in the event of an expected job loss or unforeseen expense. Second, an emergency fund eliminates the need to sell stocks when your portfolio falls in value, like I mentioned before. There are tax implications for every buy and sell in the stock market. God forbid you lose your job. You'll be prepared to survive another 2-3 months before you're able to find another job. So this is why it's very important to have an emergency fund available. The article is recommending that an emergency fund in the neighborhood of 3 to 6 months worth of living expenses might be a good idea to have, guys. However, some people are saying all the way up to 12 months will be even better. Think about this, guys. You lose your job, something happens, God forbid, in your family emergency or something like that. You should have at least 3 to 6 months emergency fund. This is something that I do agree with Dave Ramsey. But if you have even 12 months, that's even better, right? Living expenses. So this number is going to come from your budget, okay? You got to look at your living expenses every single month and make sure that you put that money to the side and do not touch it. Remember that long-term investing is meant to generate solid returns over many years. Your cash reserves hold different purpose and should be treated as a separate part of your finances. They are not the same thing, okay? On a lighter note, though, let's look at some of the upcoming earnings that are going to happen next week. All right, next week we got Salesforce, and this is a great company right there that's really dominating their space. We have ChargePoint. That's another good one that I know my buddy J-Mac will love. Right here on Wednesday, we have GameStop. We all know what happened with GameStop. The price shot up and everybody was buying it all the way up to, I believe it almost hit $600 or $700. And then now it's probably down to like maybe $100 or something like that. I still think it's overpriced, but it was one of those meme stocks, right? And people have sentimental value. Hormel, I do own some Hormel. It's probably like 5% of my portfolio. I do like the company, so I will be looking forward to that one on Thursday. If you want to see more about my opinion and more about my portfolio and all that, make sure you go down in the description and join my Patreon where I share all my buys and sells. Guys, and that's all I have for you guys today. I know this is a little bit of a different of a video, but I just want to cover a few things that I think are important to help you with your financial future financial decisions that you should be making in the future. Like I said, I got out of borrow, I got out of credit cards, I got out of everything that is not fixed rate. All right, I think the only thing I kept is my mortgage. That's it. That's a fixed rate debt, right? So that's a smart thing to do. You want to get rid of everything that's going to be fluctuating with that rate hikes, because you don't want to have to pay more than you have to every single month. It's going to cut into your money that you have to invest in the future. So that's just my opinion, guys. I'm not a financial advisor, but I'm just here to help you guys out. I hope that I did that. So make sure you drop a like, subscribe to the channel. But more important than that, make sure you take care of yourselves. And I'll see you soon.
I bring up the pain, Rico solves the mind. I make the market rain like acid rain. An investing channel you ever know, ya. I think you'll go your house, your money, leave you broke, son.